Hey guys, welcome to the Crypto Dojo free course that we're running for the Crypto Paradox Facebook community. Yeah, I mean, that's pretty much it I have to say at the start. No big speech or anything like that. We just wanted to get the community and everything like that together. Obviously, you know, we've just restarted and rebranded the Discord and everything like that. So if you're watching this video for the first time, make sure you jump across and join the Discord because we've got a heap of action happening in there at the moment. And the Discord is Crypto Dojo. You can get to our website by going to cryptodojo.trade. Let's see if I can get this happening. Cryptodojo.trade. It's not going to work. I was hoping it would give me a hyperlink. Hang on 1 second. All right, so this is the new website that Romps has put together for us. The guy's actually a wizard and put this together in record speed. So all you have to do if you want to join the website, which will give you access to watch the recordings later on. The first recording will be easy to get because we'll put that out free to the public basically, and it will be in the Discord group as well. But after that, they will all be uploaded to the website. So come in here, Crypto Dojo, click join now, and then follow the prompts through there. That will give you a free course membership, right? I'm already logged in, so it won't show what it will look like for you guys, but it'll give you access. You can just do the join for free. We'll give you access to the free course part of the Discord, which will be in here. And then obviously members that have been with us for a while, there's been a bit of a revamp of everything. And yeah, basically introducing the new head traders, which is myself still, Romps, who is an absolute wizard. He's really good with all the low time frame scalping type trading. He's pretty good with his color code combinations, and he's also our resident designer. And he's an absolute gun with the smart money concepts and everything like that. We've got Crony, who's been an absolute champion, part of the group for a long time. He's going to be posting his ideas. He's really good with like long-term plays and setups of altcoins and stuff like that. And then the other head trader and also probably our main coordinator, admin of the Discord at the moment. He's been setting everything up and coming up with the branding and everything, which is pretty cool, is Critty. He's done a great job. So just wanted to say big thanks to him. And he's pretty sharp trader as well. Like here's some of his charts. He's going to be taking us through trading ranges later on in the course. So with this course, we're going to start off slow. Not anything too crazy, but I am going to intertwine more advanced concepts as I'm teaching the basic stuff. So, you guys that, sort of veterans, been around the tracks for a couple of years, you'll probably still be able to get some good value out of even the basic things that we're going through, like, trend and all that sort of stuff, right? And then as the course progresses on, we're going to get into the, really high level stuff like smart money concepts and things like that. And so you newer guys, they're a little bit more basic understanding of how, the charts and stuff like that work. That might be really advanced for you. It might freak you out a little bit, but don't worry. You don't have to know that sort of stuff if you're just a high time frame trader to make money in these markets. So we're going to teach people different skills for the type of trading that you are. We had 900 people sign up for this course, right? And so I had to read through everybody's answers that you guys all filled out, so thank you very much for doing that. And we had all types of trades. We had swing trades, we had high time frame people, we had people who were just hodlers that want to learn a little bit more, maybe running a trading account for next bull market so they can increase their BTC holdings for the next cycle after, etc., etc. And we have a lot of people who are advanced and scalpers and stuff like that. So we've put this course together for you guys. It's going to have bits and pieces of all types of trading. So hopefully we can add value to everybody. So yeah, before we move on, should be obviously going over this disclaimer. I'm just going to read that out quickly. Please note the information provided in this trading education webinar is for educational purposes only and should be not considered as financial advice. Trading financial markets involves significant risks and may not be suitable for everybody. Past performance does not indicate of future results. There's no guarantee that any trading strategy discussed in this webinar will be profitable. The information provided is general in nature and does not take into account your individual circumstance, financial situation, or investment objectives. Before making any investment decisions, you should seek advice from qualified financial advisor and conduct your own research. We do not accept any liability for any loss or damage that may arise from reliance on the information provided in this webinar. By attending this webinar, you acknowledge that you have read, understood, and agreed to the disclaimer. All right. Now we've got that out of the way. Hopefully we can get into some content, add you guys a whole heap of value. So day one, Sunday today, first thing is onboarding to the Discord. If you're not in the Discord, please go to our website, which I just showed, and set up your account, and that will give you access, right? So the whole point of this course is to try and level you guys up and help you guys become better traders. So, you know, you can get really good results like a lot of us did in 2000, the cycle that started in 2019 and finished at the end of 2021, right? A lot of people in our Discord became millionaires, multi-millionaires, you know, heaps of people retired and everything like that. You know, unfortunately, we had massive institutions go under. We probably had 3 or 4 huge crypto institutions go under. A lot of us lost money in there, myself being one of them, lost 7-figure account, which is pretty brutal. But, you know, we're all here to level ourselves up. And, you know, I was sort of down and depressed and, you know, angry at myself and hated the world for probably 3-4 months. Well, it's only been 4 months now, I think. But I've been pretty angry for most of the time, I'll admit. But then I sort of came to the realization that the only way forward is to just get better. And I traded the last cycle really well, you know, made multiple 7 figures from not very much. It started because I wasn't in a very good financial position at the start of the last bull market. I had 2 restaurants that, you know, I'm not really a hospitality person, but I sort of invested into them and helped the company with marketing and stuff like that. And we expanded too quickly, had massive problems with the government in New South Wales in terms of opening our second restaurant. And, you know, basically we got bled out for about a year before we could open the second restaurant, paying rent. And we ended up going under. So I was pretty much near bankruptcy at the start of the last bull market cycle. And I had, at one point, pretty much when Bitcoin was at the bottom, I had to sell all my crypto to keep on funding the restaurants before they went under. And I had to restart again from, I probably had about $8,000 of entire net worth at the start of the last bull market. And I managed to trade that into a bit over $3 million at the top of the market. So, you know, obviously did fairly well and managed to turn a fair amount of, you know, not very much Bitcoin into a fair amount, even in my alt accounts, right? So I had a side account that I was running for a while. And I turned that one from 2 BTC. This is after the COVID dump. I turned that into about 2 BTC, just a little one that I was just trading on my phone. I turned that 2 Bitcoin into 13 Bitcoin by the time the market had gone full circle to the bottom. And I'm lucky that I had that account, because if I didn't, I would pretty much be back to where I was when my businesses went bankrupt in 2019. So it's a bit about my story anyway. And, you know, we had heaps of other people in the group do really well and become financially free. But basically, I sort of realized to myself that the only way forward is to get better. And I definitely feel like I could have traded a little bit better at times in the last cycle for sure. So for me, this cycle is all about just growing and getting better and leveling up as a trader and trying to take you guys on the journey with me and us and everybody else in the group as well. So anyway, let's get into it. It's probably enough rambling. Basically, to be a successful trader, you need to be able to trade market in all 3 conditions: in the bullish market, in a bearish market, and then in a ranging and flat sideways market. So our aim in this course is to give you guys strategies to be able to perform well in all 3 conditions, right? So topics for today, we're going to go over market structure, trend lines, which is really a part of market structure. And then we're going to go over moving averages, which is a great confluence tool. We're going to then cover key levels, risk management, and stop loss placement, because one of the main things that people requested was risk management, right? So we're going to go and cover that off first. I do believe that it is one of the, if not the most important thing in trading, because if you don't have risk management covered, the rest of it doesn't really matter that much, to be honest. All right, so basic market structure is the first thing you always need to take note of, and what the trend is on multiple time frames. So we want to start on the weekly time frame, and then we go to the daily time frame and start working down. This will affect the way we trade directionally, okay? So when the market is in an uptrend, like we were for the majority of the bull market, we want to be focused on longing the market. When the market is in a downtrend, we want to be focusing on shorting the market, right? Hopefully that makes sense. So basic market structure, right? What defines a trend? When we're making higher highs and higher lows, we make an uptrend, right? And when what defines a downtrend, right? Where is it? Maybe I don't have the slide in for downtrend. The downtrend is basically defined by the opposite when we're making lower lows and lower highs, right? So here's an example of a market structure break where we go from being in a bullish market structure and we break that market structure and we turn into a bearish market structure, right? So this is actually the all-time high of BTC. And a funny note, if you want to go back and check, this date here was November the 10th, right? And does anybody know, if you want to win some points, does anybody know what happened on November the 10th in 2021? Come on, somebody can answer this. Back sold the top. I did sell a fair bit. Election was a couple of days before, actually, I think. No, it wasn't. Election was way off. It was a year off or something. Give me a minute to Google it. If you guys didn't know, and you should know, it was actually CPI day, right? So the very top of the market was actually put in by a higher than expected CPI report, right? So I know a lot of people sort of joke about CPI being a meme and, economic data and all that sort of doesn't really matter. But it is important. And obviously, we're going to go into the economic data and everything like that later and how to read that. But that was one of the major things that helped me pick the top, right? So that's part of the confluence of, a big shift coming in, obviously, direction of the Fed will be pushing the market, right? But back to the basic stuff, we had the market structure break after we broke through here. So we had the highs, right? So this was the uptrend, higher high, higher low, higher high. This is sort of a higher low as well, right? And then we put in a higher high through here, right? And then you can see that we come down and we break this previous higher low, right? And we start trading below that. So that's what we call a market structure break. And then as you can see, let's enlarge this and make it a little bit bigger. We can see from here that price comes back in and rejects through here and then rolls over, right? So this level through here, and which was the previous higher low, right? That ends up holding as resistance. Every time we get above it, there's a lot of selling pressure, right? And then the entry candle was this one here, which is the doji, the reversal doji, right? So those we're going to talk about a lot. I forgot. I was meant to make a slide for these, but maybe I'll cover them in the next webinar, but I actually forgot. But these are, our main type of entry candles. And you see they sort of pop up a lot when price is getting ready to reverse and go in the other direction. But that's sort of the entry candle here. You basically had three there anyway, getting rejected from the bottom of the wick and then this level through here. And then we switch and make our low, first low, low on this low, right? And then we make a lower high, lower low, lower high. So this is something that's quite important to understand. Right, and so here we have another example of a downtrend forming and switching into an uptrend, right? So we have market structure breaking to be bullish, right? So the key turning point in the market usually comes at maximum fear. Usually these require, sorry, yes, we can. I'll just finish reading the slide and then I'll make it full screen. We're going to go into full screen in a second. We'll actually jump on the chart, FYI. Usually these require accumulation phase, but sometimes we do have V action bottoms. The reason why this one was actually a V action bottom was because the Federal Reserve basically came out and they gave $2 trillion to BlackRock. And they were also pumping crazy amounts of liquidity into the market. So after that happened, everyone was like, oh, well, everything's going to go up from now on, right? And this, obviously, crypto went up and so did the stock market, right? But we can see here that even if we didn't know anything that was going on, the only thing that we had access to was the chart, and we just lived in a little cave or in our parents' basement, like a lot of crypto traders do, and we didn't know anything going on in the outside world, and all we had access to was the chart, right? So this price action. So we have this little consolidation down the bottom, and this is actually, this breakthrough here is actually a low time frame market structure break, and we break up and actually do a support resistance flip of that level, right? And then what's happening here? So this is a higher low, this is a high, right? And we make a new high, right? Doesn't make a new low below this level. Every single time we can't have a pullback, we're making higher lows, right? Every single time we make new highs, we're making higher highs, higher high, higher high, right? Through here, these highs, but you would just consider that that's still a part of a sideways consolidation. Until we would break below these levels through here, that could be considered, a potential market structure break like this. And then we would have to see if it got rejected from the underneath of this level through here, right? And then that would be a market structure break. And we'd look for the downtrend to start forming. We'd be starting to favoring shorts instead of favoring longs, right? So the same thing happens here. So high, low, and we're making high highs, and then it eventually takes off. And that was the start of the bull run. This was a major level through here. So we're going to take a look at that in a second also. So don't stress too much about that. So here is another example of a longer play that actually is a bullish reversal into an uptrend from an accumulation, right? So the signal for accumulation is a sweep of the lows. It's also known as the spring. So don't stress too much. We're going to cover this sort of stuff off in a bit more detail later. But this candle here is the spring. So it's a sweep of this wick here, which is the ultimate selling climax, this accumulation range, right? And then we have this push higher here on the strong blue candle, which ends up being a bullish engulfing, right? So you can see, I'll make this bigger, sorry. You can see here that we come back and retest the selling climax low, and it holds that, doesn't close below that. So that's holding a support. So held a support here, a lot of buying coming in, a lot of buying coming in. And then we have our second entry candle. So this is first type of entry candle, the big pin bar, right? And then this is the second type of entry candle, the bullish engulfing. And they're both sort of giving us similar information, just in a different way. But usually what it means is there's been a strong move to the upside, and there's been a lot of sellers getting left behind, right? And basically they're in the liquidity pool, it's getting swept through this area here, and there's people that are panic selling and they're forced to buy back in, or they're shorting and they're forced to cover their shorts, which means they're actually having to buy, and then that pushes the price up, right? Then we get the final market structure break of this entire range through here. You see we have a market structure break here, but this has actually been quite a strong push. So instead of flipping the top of the range and then running like we see in this example here, right? Break the bottom of the range and then rejecting from there. We actually pull back into the range. This happens a lot in longer accumulation ranges, and people sort of freak out and they puke at this point here, and then it breaks back out, because that is also a type of short setup, right? And then you get that next wave of shorts having to close, and we push higher, right? We eventually do get the full bullish retest of the range highs back here, and there are two nice entries here, right, with the Morningstar reversal, which is a three candle pattern, and we'll cover this off later. But for you guys that are a little bit more advanced, you have three candlesticks, right? This is a Morningstar reversal, and also a bullish engulfing Morningstar reversal tells me that that is a lot stronger, right? So in bullish engulfing here, and then Morningstar reversal, that's a bullish engulfing. So this candle here closes higher than the down candle. It's similar sort of information that we're getting from this bullish engulfing here, right? So those are the main two candlesticks patterns you need to look out for: bullish engulfings, the pin bars, and then the third one will be the morning star reversal, which is like this, and then the shooting star reversal is this one here, where you have up candle, doji, and then down candle. And a doji is just a square type candle. So this one in the middle, that was what we call a doji. It's basically an indecision candle, but a lot of times it basically is giving us information. We have a down selling pressure. Then we have sideways consolidation in here, and this sort of giving us a bit of an indication that there's low time frame accumulation happening there. And then the big push out of that low time frame accumulation off major level of support, right, on a daily time frame, and then bullish engulfing the next day tells us there's a strong chance that the trend is starting to reverse now. So there's so much to every chart, and there's like how you can read it, and more information telling us in which potential direction the chart is going to go in. And then you have all the different time frames as well. It's much easier if you just traded the higher time frames as well, especially if you're just getting started. Right, so let's go and have a quick look. All right, before we move on, let's go and have a quick look at my chart. I do have some other ones here. Here we go. For other examples. Can everyone see that? All right. So here we have our lower lows kicking in, right? So this is our downtrend. And for you guys just getting started, this is your first homework assignment. I want you to go and find any part of the chart. You can use any crypto, any stock that you want. And you want to draw these in. So lower lows and lower highs, and give us the direction of the trend. Then you can come back and then you can post that in the free course homework section, and we'll look over it. But basically what you need to do is just mark out the lower lows, right? And the higher highs and higher lows, right? So we can see in here, lower lows. We come in, this is our accumulation pattern. And just like in the example I showed you just before, where is it? This example just here, which is also a BTC chart, we have the spring here, the swing failure pattern, and the swing failure, SFP means swing failure pattern. We'll cover that off later in the course, so don't stress if you don't understand that, right? And then we end up breaking out of this range, and then we have a bullish retest after the breakout of the range high, and then we end up pushing into the uptrend. So you can see we have the higher highs and higher lows, right? And so this brings us into the next part of the course, which is trend lines, right? So basically with trend lines, what we want to do is we want to connect the major parts of the swing high points, right, of our higher highs or higher lows. So in our downtrend, we're connecting the tops of our lower highs, right? So I've gone from the very top, connected to this point here. If I wanted to, I sort of could go to the most outside point, which is this pin bar candle here, right? And that would give me my trend line, right? So when we have a trend line break, it doesn't always mean everything, but it can be a good example of a potential change of character coming into the chart, right? So when we have our downtrend through here, right, we can sort of look at it like this, right? And so now we're watching for a break of this downtrend to tell us that the information on the chart is actually shifting and there is a potential reversal coming, right? So we can see that this trend, right, we're going lower lows, lower lows, lower lows, and we're going lower highs as well here. I'm just going to put that here as well for anyone that might be struggling, right? So lower highs, right? Lower highs, and we're going down, right? So now we come in here and we have, our selling climax. We don't really know that this is a selling climax just yet, but there is also on the higher time frames, and don't freak out too much about what I'm about to do, but this is a little bit more of an advanced concept coming from order blocks, right? There is quite a large order, quite a large area of support through here from what I call order blocks. You know, there's a few different ways and styles of calling order blocks, but there's obviously a really nice area, a cluster of candles through here, which there's a whole heap of orders in that zone, right? If you really want to, you can sharpen it up through here. We're going to do a session on these later on, so don't stress out too much. But a lot of the time you can pick these using the line chart and areas where the price sort of chops sideways for a little bit before moving in the other direction quite aggressively, right? And so I'll just move this out of the way, slow, low, right? We can see that in this area, price came in and tagged it quite nicely. I actually think the one that I was using was this week here. I can't remember when I was trading it back then. But anyway, we'll just take this entire cluster through here as our higher time frame support. And we can see that price comes into that area. And what happens? We get our Morningstar reversal candle through here, right? So that is telling us that is going to be possibly a selling climax along with this one, right? And so you sort of get the sweep of this level through here. So we come back down and then we get that springing action on this range, and that's the sweep there. And so we can go up onto the daily time frame and have a look at that. And we see that this is a big pin bar through here on the daily. That's also a potential Morningstar reversal as well. This one ends up failing unless it's in the middle of a candle. Whoops. Let me go back. So this one ends up actually failing the Morningstar reversal, but this was a pretty big bounce on the daily anyway from the bottom to where it ended up coming up. It was like a 10% rally in one daily candle, which is a fair amount. And so the reason why this Morningstar reversal failed is because this candle here needed to close more than 50% of the way up. Actually, I think it might have, but it's a pretty ugly close. Usually you like to see this candle close above this one or a decent way up, but that was sort of like Morningstar reversal. Then we had a doji, right? Bit of an indecision, but it ends up following through on the next day anyway, giving us the information that there's potentially a bottom being formed as well, right? So on the lower time frames anyway, we have a inverse head and shoulders here as well, which is a type of candlestick pattern, and we'll cover those off a little bit later. And basically what you're looking for is a break of this neckline through here. But realistically, all inverse head and shoulders is a lower low, right? Followed by a lower low. And then we have a higher low, right? So this is just another way of looking at a market structure break and a reversal that makes it really easy to understand for retail traders to sort of catch the move, right? And then also, what do we have here? We have another big pin bar. If you're trading on the lower time frames, right, you have to think about the market of seeing where the liquidity is, right? So the larger players, they're always going to be looking to hunt those liquidity pools, right? So here's a good example. There would have been heaps of stop losses below this level. I'll give you an example of what it looks like beforehand. So this is what we're looking at. And how many people do you reckon are putting in a trade? Then they're going like this, right? Because it's what everybody does. They put their stop loss as close to the previous wicks as they can. So, you know, most people are doing this like, oh, it's inverse head and shoulders. You know, I'm going to trade it like that. And then what happens is the next candle comes down and does that. And you can see how ugly that looked at first before it flipped to the second half of the day, right? When it looked like this. Right, how many people were looking at that and going, oh my God, this is going back to the lows. This is just another lower high and we're about to go lower and it's going to come back down to 6K, right? Everyone was looking for 6K back here, by the way. Then this happens and price reverses. What do you think is going on here? Market makers or the algorithm dumped price by pushing downwards pressure on it, and they forced sellers by going underneath this level. So people have long, there's stop losses there, and then also people are shorting below here as well. So a whole heap of orders come all the way in here, and then the larger players in the market, they sweep that all up and they push it back up, right? So you have to think about the market of areas of supply and demand and areas of liquidity as well, because the algorithm is going to drive it there. You never want to have your stop loss in a place where it's going to be easy to get taken out. Right, exactly. So very nice liquidity grab. So anyway, we push up from here. And the head and shoulders breaks and we push into our highs. Now, the key area that we need to look for, so that is the lower time frame break, right? And now we're coming to our trend line, which is the topic that we're talking about at the moment, right? So now we're coming to our trend line and we need to see, is this just going to be another lower high, right? And are we going to then make a lower low down here? Or is it going to break up and we start to make new highs? But we need to see it break this downtrend line through here before, we can get really certain in the new direction. Right, so we get above it for a second and then it fails and breaks below. But this can be giving us a bit of an indication that we might be getting a change of character in the behavior of the market, right? And so now this is broken and we're obviously gone from a strong downtrend into more of a sideways market. Right. And so that is a way that you can use your trend lines to help you. Generally, you don't want to be trading off trend lines and just being like, oh, I want to put a sell here because it's going to come back up and reject off that. It's not the greatest way to trade, right? Trend lines eventually do help us with patterns and stuff like that down the track, which is also not the greatest way of trading because it's very subjective. But we're going to give you better examples of and strategies, I should say. We can see here, we go from being a downtrend and now we have that change of character and we're in the sideways market, right? We make that spring, we sweep the low, right? And now what happened is we're gone from making a lowest low, which was the spring, right? And so why does this spring happen, guys? Because we take out this selling climax through here, and it's the same as what happened just here when that example we went over. When we come back down to take out all the stop losses that have their trade like this, right? Maybe they got in here. Their stop loss is probably going to be here, right? And, if they were looking for higher and they didn't take profit up here, right? And they were looking for up here or something like that, then the market making algorithms come back down, they take them all out, they panic sell, and then, they probably missed it, right? And look at the reaction of this candle after it spikes the low, right? The strength of that candle gives us a strong indication that there's heaps of traders trapped below here that didn't get into the market and they started panic buying and pushing up. And then this run through here is extremely aggressive from the low all the way down here. It's like 15% and it happens super fast. It's not even a whole day, right? So then those people, they have to get in a bit later and now their trade is going to be something like this, right? And they end up getting in much higher into the position after being stopped out and they have to chase the market. And that's what creates the flip into the uptrend, right? And then now we make a higher low, right? And then this is our high, we make a higher low. So now we're watching this point here. Like, let's just imagine the market is at this point here. Now we're waiting to see if it can break out of these range highs, right? So what we want to see is a breakout of the range highs and then some form of consolidation up here before the next push, right? And so this is our sign of strength and the last phase of our wick off accumulation before we push up into the markup, right? So we have the bullish retest here, which is the late chance. If you didn't get in on the spring down here around here, this is the late opportunity to get back into the setup before it moves into markup and starts to push really aggressively. Right, and then obviously we have the pullback as well. Right, so then that's our consolidation. So this is one sign of strength, this is our second sign of strength, and then it moves into markup. And then you just have reaccumulation, pump, reaccumulation, pump, reaccumulation, pump. And those reaccumulations, they create our new higher lows, right? So higher low, higher low, higher low. So now what we want to do is we want to get a trend line, right? And we're going to put it on here, right? And that's going to be our support trend line. And now when that breaks, we're going to be giving us the same example back here. It's going to be telling us, there's a potential change of character coming. And we need to be aware that possibly the market could be shifting and moving in the other direction again, right? So as you can see, we're making our higher highs. right? Higher high, right? All right, so what has happened here, right? We've broken our trend, we've broken our major support trend line, right? So now we need to sort of start getting a little bit cautious that there could be a potential distribution range going on at the moment. And so what we need to look at is there going to be a change of trend. Whoops. Is there going to be a change of trend and we make lower lows, right? So higher low. So we're sort of making, let's go back and grab these guys. We're sort of starting to make, we come up here and make a lower high. So that needs to put us sort of on warning a little bit as well, right? So if we want to, we can use more trend lines and, you know, look at this as a potential falling wedge or something like that, right? But we're not going to get into that too much right now. And see, now we're breaking below, right? We're breaking below these levels, this previous high back here. So realistically, that should start to be holding as support. And we start to have that market structure break, the same as when we had that previous one back here, right? At the Bitcoin all-time high. And as you can see, once we finally have that break, we don't even get a bearish retest here. And this was sort of starting to move into like, you know, the COVID dump and that sort of stuff, right? So now what happens is this becomes our lower highs, right? Lower high. And this actually becomes a lower low, right? Delete that one. So now we need to switch from, you know, looking at this as a bullish divergence of a 4-hour falling wedge, right? This is a bull flag. You know, when it breaks below this level, right? We want to be getting in on the reclaim and pushing up. So, you know, we might be running like Fibonacci's or something like that on here and looking for our fib targets, right? Ends up topping out perfectly at our fib target. We're going to run over that in the next session, so don't stress too much about that. But we go from looking for those buying the dips to now we're looking to for like a rising wedge, or looking to change in a trend direction, the way that we trade in, right? So now we're sort of looking for the potential of a bear flag set up here. So this was bull flag setups, buying the dip and looking for price to run in the other direction, to run to the highs and hit our high targets. Now we're looking in the other direction. We want to be, after we have this break of market structure, we want to be starting to protect capital. Maybe we're moving across from holding BTC as our collateral and Ethereum as our collateral to trade with. Now we're holding USD as our collateral to trade with, right? And what happens now? We need to get our trend line out. We're going to make this one red because it's our downtrend. And we're going to look for the potential of some type of bear flag, right? And you'd remember through here now, like everybody was getting scared. It's like the 20th of, wait, that's Feb, yeah. We just started March. This is the 1st of March back here. Everyone's starting to get a little bit more worried about COVID and stuff like that. So we've broken market structure through here. This is almost a bit of a head and shoulders distribution type pattern as well, right? And we've broken that key neckline, now we're below it. And so this shape here is the opposite to this one here. So this is a falling wedge and this is a rising wedge. It's pretty much, it's funny that we had both of them pretty much the exact same price, right? So now the trend is going down versus the trend going up. So for you guys a little bit more advanced and understand Fibonacci's, right? Where you're taking our fib level from the wick here to the wick high, right? And then we're looking for the Fibonacci extensions, right? This point here and this point here, which are two main targets. Don't stress too much if you're new, because this is going to be covered throughout the rest of the course. And then from this point here down to here, right, so we're tracking the impulsive move down, right? This is our rising wedge. So we made our lower low, right? And this is potentially going to be our lower high here. And then it's broken to the downside. And we can also see in here on our Fibonacci, I'm just going to make this white. Right, we come back off and that perfectly rejects off the 50% level of the impulsive move down. And so this is a really classic bearish continuation setup, right? And then it rolls over quite aggressively from there. All right, so now we're making lower lows. There's a new low in here now. right? And then we end up having the capitulation. Okay. Oh, I can't even, it's not letting me do that. Okay, we're just gonna have to watch it for a second. I apologize, but it's pretty quick. Right, so now we're going to stretch this across. Right, and this is what we were looking at, the price action just before. Right, so we see the break out of this lower time frame. So this is market structure through here as well, guys. And then we break and flip that market structure. Right, so break out. It's the same thing as what happened back here, right? Right, strong downtrend, sideways, break out of the sideways, flip the top of the range, and then move into uptrend. Same thing back here. Right? Let's just go on to the lower time frame, maybe the 1 hour. Right? So we could even put another line in through here. So this is what you could call preliminary support through here. It's the first bounce after the big sell-off, but it's the first probably early buyers coming into the market at this point. Then we have the final capitulation, which is the selling climax, right? And then we move sideways through here, right? And now we're starting to see potential change of trend. We break out, actually market structure, break above the preliminary support and the highs of this range, right? And then what happens? We get the bullish retest of the range high, right? So it doesn't close below this level here. That's really important, right? So this big spike up here before the previous push down, that's an important area to take note of, especially because it's around the top of this wick here, right? And so we have that breakout of market structure and then come back for the bullish retest and then push from there. And then also on the higher time frames on the 4 hour, if you understand divergence, there was a really big bullish divergence through here. And this is pretty much exactly the same thing as what happened after the FTX collapse as well, except it did pretty much the same thing as what it did here, but on the daily time frame. And that ended up being the entire bottom of this, of the bear market so far, right? And then we've hold this level again, it's retested one more time, and then price pushes further on and we start to make our higher highs and higher lows again, right? And then from there, we can put our uptrend in place. Right, so hopefully that didn't bore people who are a little bit more advanced than others. But I think it's probably the most important thing. A lot of people overlook it and then they end up trying to long this point here. And I mean, that's not the worst trade ever. Maybe this was some sort of divergence in here or something, right? 4 hour divergence, right? So you can long there, but after we've broken that market structure and, the macro environment is very bearish at this point, you sort of want to be flipping to look in the other direction, as well as this level through here, right? Which was the key support level, reject right off that. If we got above that area, right, then we start to look for longs again. But this is also the first bearish setup as well at the start of the new downtrend, so it can be a bit trickier to catch. So yeah, but a lot of the time people will end up trading in the wrong direction. Like down here, a lot of people were shorting, even though the lower time frame structure was in place that we had flipped bullish. A lot of people were shorting through here, which is fair enough after that massive dump. And we didn't really flip bullish completely until we flipped this 10.5K up here. Right. So anyway, we break this downtrend. Right. This red line, which is a downtrend, and now we sort of really have to be considering that this is now into a bullish market structure and we're back into trading like we should be catching the lows, right? So we should be buying the dips instead of selling the tops. Okay. So let's keep moving. So that is probably step one of understanding trading. And I probably made it a little bit more complicated than it needed to be, but I was trying to add a little bit more extra value for the people who are a bit more advanced in their understanding and the little things that you can look for the shifts, right? Okay, so realistically, instead of looking at this with like the trend lines, everything like that, you wouldn't just be looking at the basic market structure and the shifts, right? So here's another example here. Break of structure can give us a hint that the new trend may be starting. Here is a reclaim of the support. We'll signal a long entry. I wrote that the wrong way. We'll signal a short entry, a rejection. A reclaim of the support will signal a long. So we've broken below here, right? If we came back and reclaimed this level through here, then this is just a bull flag. And then that's a long entry we want to push to the upside. I'm just going to get this up on the chart. There's actually this point back here, right? And these are going to be some of your best, bullish trades, right? When this happens, right? So we have the break of market structure through here, right? And then sometimes it will come back up and reclaim these range lows. Then we push to the upside, right? So that's probably a really important thing to be taking note of, because if this comes like this, it's telling us that the breakdown has actually failed. And this area here is going to be trapped traders. So we want to be getting in at this point here. There was an example of that just before. I'll bring it up in a second, but maybe I have another chart. Right, so this was that exact same play through here where it actually played out to the bullish side. Right, so we had the hourly time frame. Right, so we had our breakdown in market structure through here. Right, and then we did a pretty fast reclaim of that level. Actually looks a bit better on the 4 hour. We did a pretty fast reclaim of that level, right? And you can see, just going to go back. Right, so at this point here, we're reclaiming this level, but it's not 100% certain. And there's probably a lot of people trying to short through here as well. The way that I ended up playing that is I was watching this previous high through here for a potential breakdown. And what happened at the previous swing high, right? This is another reason why we have to understand our market structure really well, right? So this was, if you remember looking at our other chart, this is one of the points where we had higher high written, right? So this is the last swing high of the previous push. We come back and we put in a reversal doji candle, which is known as a bull hammer, right? And it's also a potential morning star reversal, right? We don't get the morning star, it gets rejected, which is actually a bearish signal that bulls have failed to push it, but they end up holding this key level through here anyway and push back up to reclaim the lows of this range, right? So now it's telling us that the market is flipping back bullish again after that sell-off, right? And it's getting ready to push back the highs. So you can see instantly that big wick that was through here, because what happened was there was a whole heap of people that were shorting above this level here, right? There were heaps of shorts in through this area here, and they got taken out when the market pushed really aggressively through here. Sorry, when the algos and the market makers push the market up, and then that really aggressive push, that comes when the stops of the short traders get liquidated. And I'll show you because you only get to see it for a second. Right, so there's all the liquidations, it comes a little bit of a pullback, and then we get the strong push through, and then the same thing happened again, right? All the liquidations get taken out, right? It has a big pullback, and then it ends up filling the candle the rest of the hour and then pushes, right? And then you move into the uptrend. Right, so that is the bullish setup that we'd be looking for here, right? But instead, this ends up being a bearish retest, right? So here we come back up and we retest the low here. So it's a bearish retest and then the break of market structure. And then we move into a downtrend. So this is the same thing that I was talking about just before, but it's in the other direction. So we have our potential shooting star reversal into the range lows, right? And that is our short trigger on this candle here. The reversal doesn't stick. I think this is a Sunday and ends up sticking later in the day though, one more candle, and then it breaks down from there. And then we move into our downtrend, right? So hopefully that all makes sense. Okay, and yeah, I drew it out in there, but this is the way that you take your trade, right? Stop loss would go above this high here because you have some protection from potential order block through there. Right, and then it we were looking for the breakdown, and then the take profit would be the next previous swing high from back here. This is also known as first trouble area. So let's go and set that up again through here, right? And so this is part of our risk to reward session, which we're going to cover through later, right? So a stop loss will be above this area here, which is a little bit of a cluster, right? So if you're going to be confused about order blocks and whatever, the type of order block, is it a breaker block? Is it a rejection block? Is it an order block? We'll just look for clusters of sideways action in price. So we have gray candles or red candles, whatever your chart is showing. And then the green or blue candles here, right? That is showing a period of orders where people are buying against the trend. And then the trend starts again, we have the big move down. That is going to be an area where you will have some sort of protection. So we want to put our stop loss above that level. And then this is another order block, right? Or we could just put that as a key level through here. Right, so this is going to be our trade off the break of this market structure. So break below the range, right? Stop loss is up here, and then we're looking for this point down here, right? And our risk to reward ratio is 3. Very important here. So basically what this is telling us is if we take a loss here, I'm going to lose 1% of my account. If I win this trade, I'm going to win 3% of my account, right? So we bet 1R, so risk to reward R, we bet 1R per trade, right? And then if we hit here, we're going to win 3R. So don't worry about, the percentage move, the 8.29 or whatever, it's all BS. What's really important is how much R we actually win off the trade, because that's what the impact on our account, right? So we're risking 1R, 1%, we're going to make 3R. So this is just a market structure break, bearish retest, moving into a downtrend, and then take profit is set for the first trouble area. Okay. All right, so that's pretty much it. Bearish market structure break leads to accumulation range. So we have the bearish break, and then that leads into accumulation range. We covered that off pretty well though. Notice how after both accumulations, soon after, there's an easy falling wedge that was the easy money continuation play, right? So let's go back up. So this one here, we had the falling wedge through here, right? So big, strong breakout after the accumulation range. And then we had the continuation setup, which was the falling wedge. And then we had the same continuation setup, which was the falling wedge back here as well. So watch out for those after an accumulation, because they do pop up a fair bit. All right, we've also covered off trend lines, but I'll just read these slides out. If for the newer people, it might help them. Trendlines are a great tool for beginning traders to look for breaks in market structure and potential reversals in trend. Just because trend line breaks doesn't mean the trend will reverse though. High time frame breaks are more reliable, but you also need a market structure break as well. And usually to flip from a downtrend to an uptrend, we usually need some sort of an accumulation range and then the breakout of that accumulation range. So look for things like springs and stuff like that, sweeps of the range lows and then reclaims. Or another type of accumulation pattern, right? Here is the uptrend that gets broken, right? And we covered that off as well just before. So same type of thing here, right? We have the break. I'm just going to make this a bit bigger. All right, so we have the break of our trend line and we get the bearish retest of this trend line through here. We have the market structure break, right? So the bearish retest here is a shooting star reversal, right? So that would be our entry on the shooting star reversal of the bearish retest. Stop loss is going above this level here. And then we're getting our risk to reward, our R, of 1 to 3 as well, right? 3 to 1, I should say. Right, and then we're looking for this swing low point here, which is our liquidity, right? Our liquidity zone. There's going to be a lot of people who have stop losses below this level, and the market makers want to come down and take those out, right? And then this is the result. Okay, so we just tried to cover that off. Everybody should be understanding that pretty well. Okay, so trend lines as well can be helpful for things like altcoins when they're on a parabolic move, right? So this is Bitcoin's previous all-time high cycle in 2017 when it hit 20K, right? And one of the warning signs was that we had a change of character from this very strong aggressive move to the upside, and we broke that trend line and now started to move sideways, right? So that was a strong indication when we had that break. When you have a break of a trend line out of a parabolic move, that's usually one factor of an exit signal, right? Can be very helpful at altcoins that are pumping very hard. Okay, so now we're going to go into key levels, horizontal support and resistance. Basically, trend lines and indicators are great, but for confluence and learning at the start, but horizontal levels are really where the game is won and lost. You need to think of the market in levels of price and where the liquidity is around those highs and lows, right? So the algorithms and the market makers will push price there to fill their orders against the retail traders who are getting stopped out and liquidated, right? So this is the funny little meme that, I've been sharing for a long time now. And basically goes like this. So you have, everybody starts out looking at horizontal support and resistance. Then we go to trend lines and moving averages and RSI, and you're like, oh my God, stuff's amazing. The brain starts to light up a little bit. We get onto Ichimoku and the TD sequential and volume profile. And we got all these crazy things going on all over our chart. And then we end up going full circle. We come all the way back to horizontal support and resistance and just trading off based on the price action of the chart, right? Okay, so key levels from horizontal support and resistance. We're going to be looking at, we want to start on the monthly time frame and then work down, right? So start on the monthly and then work down to the weekly, the daily. You can also throw in the 3-day and the 12-hour as well. There's two pretty key levels also. And then we have the 4-hour and the 1-hour as our other main time frames that we watch. Right, so swing highs and swing lows is where the liquidity is sitting, right? So you know how we just went through our higher highs and higher lows, right? Those levels through there, that's where there's going to be big pools of liquidity that the market makers are going to want to come down and take out before continuing in the other direction. And this happens a lot more on the lower time frames as well than the higher time frames. Basically, big money needs these to fill their positions, right? That's why we usually see a spring in the accumulation range. Okay, and having our key levels in there can help us to pick those out. So we're going to go in and just map out a few ranges in a second. But this is a really good example here. So this is Bitcoin on the monthly time frame. And we can see that this is our monthly highest close, right? So I had this in my chart as a key level. And we can see here, after we came out of the 2019 bottom, we had a really strong rally and came up and we rejected off this previous all-time high of the monthly close. So the monthly highest close, we came up there and perfectly tagged it to the dollar. And then we went through another year of reaccumulation, right? And then when we finally get a breakout of this monthly high, highest monthly close, that's when the real bull market starts. And then we launch from there, right? All right. Okay, so here's a really good example. We can also use our trend flat horizontal levels. And we can also use order blocks, right? So here's a really good example of order blocks through here. So this is the monthly time frame still, and we can see through here that, let me just make that a little bit bigger. We can see through here that when we get the monthly through here, every time we come back up into this monthly block through here, right, which is going to be acting as resistance, we can see price sells off. Every time we come, this price sells off, price sells off. And then we get the breakout of this monthly, right? We have the shooting star reversal, which fails to close 50% of the way down. Right, we get the close back above this monthly level through here, and then we push up higher from there. Okay, so that was a really big signal that the bull market was getting ready to start. And then when we broke out of this 14K level, that was the next signal. All right. So let's get our chart up. Duplicate this. 1 second, guys. Sorry. Turn off this moving average. All right, so we're going to start on the monthly time frame. All right, so this is our monthly level through here. Right, and you can see when price came up to here on the lower time frames. Oops. Right, we ran very aggressively into this level. This is also a Fibonacci 618 level through here as well, right? But on the lower time frames, there's actually head and shoulders right at this level, and it actually helped me to pick that top through there. Anyway, what we want to do here is we want to be looking at our monthly levels first. What have I just done? We'll look at our monthly levels first, right? And looking for those key levels, right? And then we go down to the weekly. So we put our monthlies in, right? Weekly close through there. Right, other key weekly levels, obviously this point through here, right? And we can see perfect tags of this level, right? So I'm looking at this, when I look at this like this, right? That was probably a little bit too far. But I'm looking at this as that is a key level. I want to see how price reacts to it when it gets back to that level, right? And so when we're here on the weekly, and this is also an order block through here as well, right? But regardless, it's a key level, right, that we want to be looking for. We're going to remove this monthly. We're looking and we're watching for price to see how it reacts and closes on the weekly level, right? And so how the price closes on that weekly level is going to help us set the direction of the trade sorry, I shouldn't say direction of trade, the direction that we want to be looking to trade in the next session, right? So if we closed up here, even though we rejected the monthly, that would be a bullish signal because we're closing above key weekly resistance, right? And we would look for the weekly to be pushing more in that direction for the next week, right? Instead, what happens is the weekly closes like this below this level, right? Which is telling us that there's a potential for a bearish reversal and to start to looking for trades in the other direction, right? So then we need to see how the next few weeks end up closing. What happens is it closes right on this key level, right? So telling us potentially bearish, right? Every time we get above this level, right, it closes below that level, right? So selling pressure comes in every time we're above that level. Right, same thing happening here again. So then we get the double top at a key weekly level. This is telling us the market structure is starting to shift. We're probably going to go in the lower timeframes from being in an uptrend into a change of character now and potentially moving into a downtrend. So it starts to put us on a little bit of warning, right? So this is how you use the monthlies and the weeklies and how the candles close according to the key areas. It's not about what happens, what the wick does. The wick can give us an indication of where people are trapped in the market. It's more about where the candle ends up closing. And more importantly, the most important thing to pay attention to is where the candle closes in what happens in the candle, the price action of the candle leading into the close. So on a 5-minute candle, for example, the most important information to get from that 5-minute candle is what happens in the last 30 seconds. So it's the same in this weekly. What happens in the last couple of days leading into the daily into the weekly close, right? Okay. Whoops, what is going on here? All right. So now that's how we're putting in our weeklies, right? We can do the same thing right through here. And we want to be looking at our wicks. So this, when we're looking at the previous all-time high, right? And this is one of the ways that I actually was able to catch the top very nicely, is because I was looking at, you know, these highs through here, and I wanted to see how was price going to react to these key levels. Were we going to close above them? Were we going to leave big SFPs and wicks above those levels or not? Right. And so when we come into this weekly like this, I'm looking for a close above this level. So my chart would have looked something like this, right? Had this weekly order block through there, rejected from that point there, right? So confirmed resistance. And I'm looking to see how price closes. We actually closed above here, and I was like, wow, maybe this is going to open us up to push to 80K or 100K or something like that. And it was looking very strong at this point after this bullish reversal down here that we were just looking at a second ago, right? Right, the market is like this. Okay, we're looking good, but we need to close above this level. We don't want to see the market trade above here and then pull back below this level. And we definitely do not want to lose this level through here. Now, other things we're looking at as well is this is getting into October, seasonality as well. The last part of the year, the last quarter of the year should be the most bullish. So we really need to push and take off from this point. Right. And then look at how nasty this rejection is here. Right. And then what happens? This is going to be a lot of people above this area here. They're going to be trapped traders that got caught in the liquidity above here. Right. So that was the sort of first indication that, you know, wasn't looking that great, but you know, the market was really strong and we end up holding, rejecting the shooting star reversal, which is, you know, obviously means we're still bullish. I'm pretty sure we close above this key level through here. Right. So when you have a failure to dump after a candle like this, a failure to break down, so it's a failed breakdown, failed shooting star reversal, that is a bullish signal because the bears should have dumped the market at that point. Does that make sense? If the bears were in control at this point, the market would have closed down here and then that would have been the top and we would reverse, right? But they're not in control and the bulls end up winning this weekly, and that's why we end up pushing up. We have to still be cautious of what happens next, right? So let's go over that one more time, went a little bit fast. Right, so now we're watching to see, okay, so the candle is at this point here, right? We're looking really good, pushing towards 100K, right? Everyone's crazy bullish. People are piling in because we've just broken out this level here, we've just broken out this level here, you know, delete the bears, blah, blah, never listen to anyone that's bearish ever again, all that sort of stuff's going on, right? So what happens next? We actually have CPI data come out and the market starts to pull back quite aggressively because we hit the all-time, I think it was 40-year high in CPI, which was above 6%. And then look at how the weekly closes, right? That is bearish, right? Swing failure patterns here, swing failure patterns here, not good signs across the board. And then the next week we have that shooting star reversal, right? And where does it end up closing? Right, that's going to be important as well. And then we closed below this level here. So if you didn't get out after these SFPs and sideways through here, the indication was the close below this block or inside the block. It could have reversed out of it. That is possible, but obviously didn't, and it broke down further and we get a close below that key level. So this is how we use the swing points of the weekly time frame to give us information about what's more likely to happen in the next week coming, right? And that was one of the major points that I used to help me sell the top. And I ended up selling pretty much all my altcoins after this weekly closed like this at about 65K. So yeah, that was one of the big things that helped me swing that 2 Bitcoin account into 13, 14 BTC by the end of the cycle, was because I sold pretty much everything at this point here, right? So, and then I put out that video as well on exit strategy if you want to go and watch that. It's on my YouTube channel that talks more about this. So does that make sense how we use the weekly time frame close to help us set direction for what's going to happen next? Is anybody still listening? Can't tell. Everyone's just having a side chat. Awesome. Awesome. So yeah, the weekly is very, very important, right? And so then we can go down from the weekly, we can go into our daily time frame. Right, and then we need to look for our key levels when we're setting up our chart and the daily. So I want to have my weekly key levels in. I want to have my daily key levels in as well. And one of the things we were looking at before was this breakdown in the market structure when we had the reversal here. And you can see that this bullish order block from the weekly time frame, which I grabbed from just here before, we can see that that's pretty much the range low in here as well. So this is another signal, especially when we go down into the lower time frame. So we had the short. Yep, this is one here. We had the short entry on the pin bar here because what's happened here? So, right, this candle here is a bullish setup entry candle, right? At the top of a key level on the weekly time frame, and this gray area is a weekly bullish order block. So potentially you could long off that, right? So that is a bullish entry. I'm just going to look back, right? So if the market was still bullish at this point, right, you would be looking at something like this, or at least, the SFP back to the first trouble area, which is here. But you can see this is sort of in the middle of nowhere. I would like to see this same candle, but it sweeps this low here and then comes back up, right? And takes out this level here, because that's more of a swing failure pattern. This isn't really an SFP. It's just a bull hammer candle off the top of an order block, which can be an entry, right? And sort of similar thing happened back here, and you could have taken this trade to the all-time high, and it would have paid out really nicely. But the market had already flipped. So the other type of information you can take from this is you do get a bullish setup. It's not the greatest one, but it's a bullish setup, right? That fails. It can be an indication that we're actually flipping into a bearish market, right? Hopefully that makes sense, guys. So when a bullish setup fails, it's probably because the market might be more bearish than you think. And when a bearish setup fails, it might be because the market is more bullish than you think. And we're going to look at that when we go into patterns and pattern failure and stuff like that in a little bit. But you can see on the weekly time frame, we have our weekly order block through here and our weekly key levels, and price comes up into that, and then it gives us the entry candles here, 1, 2, 3, getting rejections through there, and we never come back above this level through here, right? And that rolls over from there. Right, and then we go down onto lower time frames. We can see the price action through here, right? This is a potential sell candle as well. Right, let's have a look even deeper. And this one here is actually a pretty nice short entry through. Usually I would like to see that come up and take this high out like this, and then you have that one there. But basically what we're seeing here is rejection, rejection, rejection into that weekly order block. And every time it comes back into that weekly order block, it doesn't spend very long. Like look at the amount of candles in this range, right? The amount of candles in this entire range through here, and look at how many are inside the weekly order block, right? It's like got to be like 5% of the candles in this entire range, right? So if you take all of this through here, right, look at what's inside that order block. Hardly any price action. Every time it comes into that, it's getting sold very aggressively, right? So that's an indication. If you're getting pushed down by a weekly order block like that, or weekly key level on the lower time frames, it can be a strong indication that this is getting ready to roll over. And we're going to look at trading range and stuff like that later in the week. Critty is really good at those. He's going to take us through some of that. I'm going to take you guys through some wick-off accumulation patterns as well. But this is a good example of just a small tighter range, and then just before it sells off. And this is typical bearish market price action, right? So we have our key levels through here. Price comes up, takes out the high, right? It did it here as well. And so there would have been people doing this, shorting from here. All right, and they put their stop loss just below there, and they're looking for a take profit down here, right? And so this second candle that came up was to take out all the people that did this and then brought their stop loss down after these candles, right? So you'll see this happen a fair bit when the market is bearish, but it will like to push back up, sweep the previous highs, and then roll over, right? Pretty much same thing happened here. So 2 highs through here, sweep the highs, roll over, sweep the highs, roll over. That's standard bearish market price action. So hopefully that makes sense, how we use the weekly time frame to help us make decisions. And then this ends up being a daily order block, right? And so if we're going shorting through here, we can put our stop loss, let's just say we shorted here, we can put our stop loss above these levels here. And we know that we've got weekly and daily time frame key levels through here that we can put our stop loss above, and it gives us a bit of protection, because if price gets above this area here, what does that mean? Right? It means most likely the market's is reversing and going in the other direction. So that means our trade idea that we're going to break down, and this is going to be a high through here, is invalidated. And ultimately, that's what you want to be doing with your stop loss, right? I know a couple of the guys, like Dirt Doc, for example, was saying before, talking about stop losses, right? We're going to cover those in a second, but just a little bit of info on stop losses here for you. You need to be putting your stop loss in a position where if price goes to that point, your idea that you're basing your trade on is invalidated. We're going to cover that off a little bit later, but yeah, so basically on the low time frames, we look for the dailies, and we put in where our key, let's get out of the replay. We put in where our key daily levels are. So now let's go and have a look at how this looks like on current price action. So yeah, that weekly close back here ended up being an important level to the bottom of this range as well. We're going to get rid of it anyway. Right, how does it work out on current price action? So we want to be looking at the close, the candle close. Just going to make these a really obvious color. So red stands out, I think. Right. So the wick low, so this is our selling climax, right? So we had that breakdown through here, and then we had sideways action now. So that's a change of character. So now on the daily time frame, we're going to be mapping these out. So daily lowest close and the selling climax wick. We want to have those in. We can see how price reacts to these levels every time we come down here. So, this can be an area, some people call this a demand zone, right? Every time we come down into these areas, we do see buying start to come into the market, and we push up out until the FTX ends up collapsing, and then we go into the range low, right? So then down here, we would do the same thing, right? Lowest close. Just going to use, right? And then we can see we get the swing failure pattern down here. And then we're going to cover this later on if you don't understand, but we also had the bullish divergence through here, right? And then one important thing as well is to see the break above this point here, right? And then ultimately we end up breaking it again at this point, and then the push after that break. So this is our range high through here, and that's sort of the break of market structure, what we were talking about before. This is like a mini accumulation range, and this is obviously a larger accumulation range. But at the same time, we need to be looking at our highs, right? So there's this wick from back here, which sort of acted as resistance. And then this wick here on the daily time frame. So we get rid of the top one, right? And then we can see when we made our highs back here, right? So we're looking for the key swing points in the daily time frame. So key close point, key swing point in price maximum at this point is the wick, and then the key swing point high of this range, right? And we're going to see how price reacts to this back here. And every time we came back up to this point, selling, 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 right? Really nice SFP here. A couple of guys nailed the trade right at the top there on the low time frames. Romps was one of them. It was a really nice trade. I think Mingy got it as well. And we've been going down ever since. So this is telling us that we're still in a range bound environment. But these equal highs here is also a target for liquidity as well, right? So we're talking about those key swing points in the market just before, and how price likes to come back into them and takes out those areas, right? So Rom's is going to be talking about smart money concepts and everything like that later on in the course, but equal highs is something to take note of. So potentially, the algos might like to do something like that and put an SFP in that level before we come back down. So something to be aware of. Doesn't mean it has to happen, but it's just something to take note of. Other key daily levels, right? This wick here and this close high. And you could also take this as a order block. Right, I always did order blocks as actual the closes, and I like to look at how the price closes around that. If you're doing the smart money concepts order blocks, they use the wicks as well, right? So it makes it a much wider range. But I find price reacts to both actually. But this one didn't come down all the way to that point there, but it did do the wick. So if you had the wick, it would have worked out better. But then we can see, so we're starting to map out the key levels in our range here, right? So let's look, if we're coming back to look at price, this is what it looks like. Okay, we've got this bull flag through here, right? Usually at the bottom of a bull flag, we're going to have some sort of a sideways actions. Smart money concepts call this a breaker block, I'm pretty sure. But I just call these order blocks anyway. And then you look to basically long on pin bars that come in, and you can see just like based off just this one concept through here. And I sort of taught this to myself actually years ago, because I would see this happen on the 5-minute time frame all the time. When the market is really bullish, it will pump, and then you'll get that. What are we doing? Different color. It will pump like this, right? And you get the green, and then you get one candle go back in the other direction, and it'll be red. And then you'll get the pump back up, right? And that will be the green again, right? And then it will come back to this level multiple times. And then you sometimes get wicks like this, right? And then, you get the bull flag and it plays out. Like I've seen that happen like thousands of times, right? So I just sort of started being like, okay, this makes sense that is the key area. And that ended up being, a smart money concept thing that I've been trading for a long time. But anyway, you can see here that on the 4-hour, every time we came in, we got those big tails on these pin bars, right? Setting up for Morningstar reversals every time it came into that order block through there, right? And each one of them would end up being quite a nice trade if you're just trading through this range, because this was the range low, right? So anyway, we have this set up. Right, if this breaks down, the area we want to be looking for is down here. And there was a lot of people that were looking at this potential as a short setup, right? This is our 4-hour. I'm going to make this red, right? And then what's this here, right? Big wick, right? So bearish price action, sweep all this range, get that big wick into this consolidation through here, and then reject, right? So the short was this. Right, you could either target range low for that, right? Probably these wicks down here. Some people will go for what, sometimes we call low hanging fruit, smart money concept guys, the easy target, or you could be going for, this level through here or down through here as well, for these wicks to get taken out. All right. And then the next key support level that we're looking at is this daily level that we picked out before. So we've got our daily order block through there. We've got our wick high. We've got the candle close level through there. And we're going to see how price comes back down and reacts to that, right? So we sell off. People who are short taking profit through here, right? And then we have our bullish divergence through here. And low time frame, that's on a range. So now what we're looking at, we've got our high time frame levels set up. We've got our high time frame levels set up. So we're coming into that support level on the daily time frame that we've set out from our daily key level. Then we've got our bullish pin bar through here. At the same time, that's a bullish reversal. And then what's this, guys? We've got a low time frame break of market structure. So this is our range through here, right? So Kuji's going to take us through ranges later. How do I want to draw this? Oops. right? So taking the range from that point there to that point there. And this is our trading range through here, swept the range low. So just like we looked at all the other accumulations, right? But they were on higher time frames, sweep the range low. We also have the bullish divergence through here. And then we break out the top of our range here. All right, shooting star reversal, doesn't go anywhere though. And then we get a bullish flip of the range high through here. We're shooting star reversal into morning star reversal, but see how this candle here, really good example for you guys who are a little bit more advanced. We have the shooting star that confirms, but it's not a shooting star that is it's not an engulfing shooting star. So it doesn't close below this level here. So the little bits of information you can get from, okay, it's like, an amateur person would look at this and they would say, oh, that's a shooting star reversal at the top of range high. This should be starting to come back down because the shooting star reversal confirmed. Right. But the more advanced people will say, okay, we're a shooting star reversal. It's still above range highs here at the moment. And it wasn't a engulfing shooting star. So it's not super strong. Right. Let's see what happens in the next candle. The next candle is this one here. Right. And so now we have a morning star reversal. And you do see this happen a lot of the time. Right. You have the reversal pattern. It doesn't end up being right. Same sort of thing here. This one closed, but not, I don't know if that closed above. Let's have a look. So the trick that you can use is just get out your measuring tool. It just closed above, so sort of confirmed. And then it rolls over the next candle. So you can't just use it as, okay, there's a morning star reversal. It needs confluence as well. It's just one factor. So when we have the morning star, but then this push up here closes, that's really aggressive because it closes above this candle, the down candle. So the one candle of the morning star reversal, right? Obviously, that is a lot more bullish. We're looking for upside reversal, right? And then it ends up pumping and we make the next high, right? So that's how you sort of like load all the time frames into each other. Hopefully that makes sense. Okay, so monthly key levels, weekly key levels. We can map out this trading range like we did back here. What's the time? Running out of time. I don't know if I have this one somewhere. So this was the previous range, and I just had all these weekly order blocks mapped out on that chart back here, right? So it's just going off the weekly key level. So order block here, right? There was also like a little one through here, and you see we rejected off there. This cluster through here that price ends up bouncing out of through there, right? These are the main ones anyway, without me having to map them all out. I'm just going to drag this up. Right, and we can see how price reacts. Even this one from back here, right, where we end up rejecting off here, rejecting off here, rejecting off here, ends up flipping into support at this point here. And then we see the market sort of push and move to the upside. So just having these weeklies on your chart, and also like this weekly order block back here, you can go have a look at that on the chart actually, ends up being where the COVID low ends up stopping. So this weekly order block, which is basically the top of the accumulation range through here, is the support level that we ended up saving the market with the COVID dump, right? And then this one through here, right? So weekly key level, right? This gave us a lot of really good information because we closed below this block, right? Which, over here was support, failed to hold a support, right? So now we're watching for that to be reclaimed. When that's getting reclaimed, telling us the market is bullish, right? Through here, we actually got a close right on this weekly order block through here. So that was telling us the information that potentially the next candle after this one here, because we closed here, right? That this candle potentially is more likely going to be bullish. And then because this one closed above as well, right? That's telling us that support has held and more likely that the next candle is going to be bullish again, right? And that was one of the things that helped me get into the bottom of the market down, under 5K, under 6K, under 4K, right? So you know, it's like just high time frame analysis like this. I know a lot of the people in the group, you know, more high time frame traders and stuff like that. You know, this sort of stuff is like going to be your bread and butter. Especially later on, we're going and looking at like a lot more altcoins and stuff like that. You know, it's the same type of thing. You're looking for, you know, the key levels on to be swept to get into your accumulation and stuff like that. And then breakouts for the top of the order blocks on a weekly time frame is going to be telling you that that market is getting ready to move out of accumulation into its markup phase again. But yeah, hopefully that helps and makes sense. And you can just put these levels in as, you know, support and resistance levels using your trend line. Now, if you want to keep this completely flat like this, you just hold down shift and it will stop the trend line from moving around, and I'll just have it as a horizontal level. Okay, let's keep moving. Okay, so this is the new trading range. So this was the previous cycle's trading range after we put in the bottom. And at the moment, potentially right now, the market is at this point here. So we just had the breakout of our accumulation range, and we're possibly pushing towards, you know, the beginning of a new run into reaccumulation, right? That's why I'm spending a lot of time looking over this area here, because we're probably about to have a year of price action similar to all the stuff that we've just been looking at, right? So then now, how's it going to look on the current price action, the current cycle mapped out? Right, we can look here and we can see how price is going to react to these levels. So key levels that we're looking for, this swing low point, which is actually the bottom of a bull flag. I think that's when Elon Musk bought. We had that reversal. That's also what we were talking about before. You can see on a weekly time frame, we had that Morningstar reversal pattern that's an engulfing. And then what happens after the engulfing Morningstar reversal? You get that confirmed changing trend, and the market has two more really strong moves after that to the upside. Right, and now we're putting in the shooting star reversal on the weekly at a key point in the market, right? Key weekly order block. So we're waiting to see how price is going to react when it comes back down here, right? We're waiting to see if price comes back down to this level here, which is also our daily and weekly order block. How's price going to react to that? If we break below that level, then we're going to be looking for this weekly order block through here, right? We'll get it up. Just remove all these. If you want to know how that trick, that's hold down control. You can select all the levels. So this weekly through here is currently acting as resistance. I realize we're still on the replay tool. Excuse me. Okay, right, which is currently acting as resistance, right? We're going to put in our swing point as well. Let's make these white. Yeah, that'll work. I think this level through here is probably a good one to look at. And then this one through here. So if we do come back to this level, which I think is probably likely over the next week or so, we need to see if price can hold this weekly order block through here. Now, if it can't, then we're going to be looking for this level. And then I would say probably this level through here, right? Would be the key areas to look for, to see and look for a price to reverse, right? So if it does, you know, fail to hold these two, then we might get that sort of price action, and that would be an entry set up to move to the upside. Right, other key levels that I'm going to be looking for price and how it reacts to this one for sure, because look, we have like, I don't know how many candles that is. 11 bars pretty much, and there's one that is there's one green bar out of 11. So we're looking to see how price reacts to this level at pretty much at 30K, right? Other key ones also going to be this one back here. And then I think this level through here as well, which in my opinion, if we do get a bear market rally over the next few months, this is probably going to be the level that it caps out at, similar to this level through here being the level that we capped out at 14K in the last cycle, right? And then, you know, don't want to get too deep into Fibonacci, but, you know, this area through here was the 0.66 and the 0.618, which is we'll call the golden zone, where we like to take short entries from, right? So line that up through here, sort of through a similar zone, right? It's in that area. So maybe we can look for, do the smart money concepts one, and that could be an area through there. But that's a very wide range, right? That's why I like to sort of pinpoint them. It's a 10%, $5,000 range. That's why I prefer to be a little bit more precise and just do the candle close. But you can work out how you want to do it. Okay. Okay, daily key levels. We just pretty much mapped that out exactly. Okay, we're going to move on now to moving averages. Now, moving averages are a bit of a meme, but there are a few that I think are really valuable to keep a part of your trading system and at least keep note of, right? So you might want to write these ones down. Oh yeah, so the homework for that part is to just get a daily and weekly chart up. You can use Bitcoin and copy my levels if you want to, but we want to basically map out all the order blocks like that, right? You can do the previous cycle like this if you want to, and just look and see how price reacts to. And then you can just put in your trades where you would look for price action to match up with those key levels. And you can just put in the trades. So like, down arrow through here, and up arrow through here, because you have the Morningstar reversal, down arrow through this point, because you have the shooting star set up there, up arrow, wherever it is you want to. And then also do the current range as well, just so you get in the hang of, you guys will get a copy of the slides, just so you get a bit of a hang of, of drawing in the levels, right? And seeing how price reacts to these levels. Then you can zoom into the lower timeframes and look at how price is reacting to those levels on those timeframes, right? So that's the homework for that section. So moving averages, let's get stuck into these, try fly through them. They're pretty easy to understand, right? They're a line and they take the average of the previous X amount of days. So if you've got the 12-21 crossover, which is on the screen right now, it's two moving averages, right? If you're using the 200 daily, which we're going to get up now. I swear I just had one up. Yeah, with this one. What I'm going to do is just remove these drawings. So you go like this, go to your indicators and you type in MA, right? Then click on moving average. Now it's going to come up with a 9 and it's going to be blue to start off with. We're going to change this one to the 200, right? And then we're going to change it to being red. Because generally the 200 moving average is red. Now on the inputs, you can change the time frame that you want it to be displaying, right? So you can have it on the chart, which is going to be changed by here with a weekly, right? And then here on the daily time frame, so we can change the time frame to if we want to show the daily time frame while we're on the weekly, right? Or we can change it to show the 4-hour moving average while we're on the weekly time frame. So it's really handy, especially when you're on lower time frames, right? So I want to have the weekly moving average. I can zoom into the daily, right? And so then I can see here the price comes up. So we have our daily key level through here that we're looking at, right? And then we can also see that this is the 200 weekly moving average, which is also going to be confluence for resistance as well. So a combination of that weekly 200 moving average and the daily time frame swing high level through here is going to be a confluence of selling pressure. Plus, we also had confluence of the RSI divergence, the relative strength index divergence, which is something I'm going to cover later in the course, right? So it's a confluence of multiple things, ends up putting in the top in price because there's so many reasons for different people to be selling through here, and the algorithms as well, and then the confluence of them. That helps us, just gives us a little bit of extra confluence, having the 200 weekly moving average here on the daily time frame, right? And then we can look on the 4-hour. We can see it only closed above here one time, even on the lower time frames, right? So the 200 is a pretty handy one. 200 weekly usually supports price, right? So the only time Bitcoin has ever been below the 200 weekly moving average has been during accumulation phases, right? So dip below here, dip below there, then got back above very quickly. And then we went on the greatest bull run of all time, pretty much. Touched it here, touched it there, and then moved on. That was obviously 2019 bottom. Tagged it back here as well. But COVID was the only time we really traded below it properly. And then we've come back up and obviously launched again. And now this is the only time we've traded below this much. Now it's flicked into resistance. Is a bit concerning, right? And so we're on the daily time frame here, but this is actually the weekly 200 moving average, because remember, we can change the time frame that it represents. Now let's go and have a look at how this works in the stock market. So we're going to get the ES up here. So the previous low. I got a pop quiz question for you guys. This date here, October the 13th, what was that day? It's their New Zealand's birthday. Thursday. What happened on Thursday? Someone's got to get this. Come on. CPI. Yes. CPI came in for the first time lower than expected. But also what was here, very important to note, was a 200 weekly moving average, right? So we had confluence of things happening with the economic data coming out bullish, right? And also we had, manipulation of the sell-off down, because as soon as CPI came in hot, it actually sold off really aggressively and then reversed, and we've been up only ever since. So 100% manipulation. But there's something really cool I'm about to show you in 1 second, which is a very advanced concept. Some of you guys are higher level traders will take something away from this, I think. So anyway, we bounced off the 200 weekly moving average, but we just go like this to the weekly time frame and have a look at what is on this level where price ended up stopping at, right? What is here? This is a gap in price, right? This is a weekly opening gap, or a lot of people on Twitter are calling this new week opening gap. But it's just a gap, right? It's called a gap imbalance. And the market does like to fill these gaps, right? Anyway, so put this gap out and extend the box across the right. You can see that perfectly came down to fill this gap and then reversed out of it. There's some magic for you guys right there. And this happens all the time. So this was the closest gap, right? So see, price action was trading here, right? The manipulation came down to fill this gap, right? On the CPI data drop, and then price reversed out of there. And then we've been up only ever since. I'm not going to read that. Oh, love it. Yeah, so for these gaps, similar sort of price action happens for Bitcoin. So keep your eye on CME, BTC, 1 exclamation mark. All right, let's keep moving. Okay, so 200 the daily, 200 weekly, and then the 12-21 crossover. The 12-21 crossover is a really handy one, especially for lower time frame trading. It works really well on the daily time frame as well. So let's get that up quickly. It's a good one for confluence. And then also it's EMAs as well. So the 12-21 is EMAs. This is probably the most basic trading strategy you can have. It caught the bottom really nicely. I was still licking my wounds from the FTX collapse. So I wasn't paying attention back here. But generally, this is a rule that I use, that I either hold my collateral in Bitcoin or hold my collateral in USDT for trading with. When it's the blue line is on top of the orange line or yellow line, whatever you want to call it, I move from USD into Bitcoin. And so I can catch that move with my collateral on my spot from here up to here. So it gave you the perfect entry right at the bottom of the range, right? Through here, gave you the crossover. So the entry was on this candle, or if you got in late, would have been this candle here at 17,100. Right, and so that's just got to cross over to the downside. So that trade through here, let's just say we got in a bit higher, right? We're giving you 37, 38%. But more importantly, the R that it would have given us, right? So trading this strategy, the stop loss is below this level here, right? You're going to get pretty much 12 R on that trade. So 12% account increase just from taking that trade, right? It's a pretty easy, very mechanical trade. You don't have to think about anything else but taking the long entry when you get in here and when you get out there, when the cross down. Right, obviously this doesn't perform very well in sideways markets, but it does perform, it will always catch the major move. I do use this sometimes as well. So let's go back to the daily. Sometimes I do use this as additional confluence. So let's mark out our key levels again on the daily. Right, what we had back here before. Go into the 4-hour. So we had our trading range we were looking at before, right? Right, so we sweep below the trading range, come back in, come out the top. And I discussed all this before. We had the 4-hour bullish divergence through here as well. Right, if you still weren't in after all the setups through here and the breakout and the retest, we also had the 4-hour 12/21 crossover to sort of give you the warning that, hey, this is probably getting ready to pump, because these guys only cross over usually when there's a move. Obviously, again, in sideways market doesn't perform very well, but generally when there's a move, there wasn't a cross, but it came very close here. It will give you the signal, right? It's the crossover here on the 4-hour was at this point here at 16,600. It just gives an extra confluence. So this is like training wheels for you guys. If you're looking at setups and you're like, oh, I don't know, because sometimes, and it's right that bullish divergences will do this a few times, right? And then it will finally break out to the upside. It can be just a little added confluence to wait for the 4-hour 12/21 crossover and to improve your strike rate a little bit after a bullish divergence, right? So if you're not getting in, like, you're not sniping entry doing this, right, then you get the breakout through here and the 12/21 is crossed over to the upside. It can sort of just be a little bit of an indication that, market is getting ready to move to upside and push. Yeah, like Rom says in the chat, it is a lagging indicator, right? It's not really something that you would take a trigger on, but I think it is something that is a really good training wheels for newer people that are getting involved. Because I know we've got a lot of people who are like basic level traders, and they just want simple trading strategies that can help them on higher timeframes, right? So on the 4-hour and on the daily, especially, this can be really handy. But you don't want to use it when it's like in accumulation for ages, because you can get chopped out a fair bit. You can use this on altcoins as well. Let's have a look, something like Matic, right? Matic didn't really spend that long in sideways consolidation. But we had the crossover entry here, exit here, and then you would have got chopped out a few times through here with some failed signals, right? And then again from up here. So it's definitely a confluence type of a indicator. You don't want to be basing your entire trading strategy around it, but it can definitely help, in my opinion. And then the 10-month as well is a good one for you guys who want to trade really higher time frame, especially like things like the ES, for example. A lot of people use the daily 200 daily moving average, right? So the 10-month moving average, which is similar to the 200 daily moving average, but on the monthly time frame. Actually, the statistics on this do outperform just a basic 200 daily moving average. And we're gonna have to go to SPX. So we get the rest of the data. But basically, the idea of this is that it gives you a signal when you get a close below the monthly, right? When you get a close below that, it gives you a signal to get out of the market or at least be hedging, right? And then when you get a close back above, you can take the hedge off. So sort of see through here in the bear markets, it stops you from really taking any huge hits. And that's the reason why it does outperform the market on a longer term strategy. Because say you would have sold out here, right, and a close below, then you buy back in here, you take a few losses throughout the bullish periods of the market, but you're never going to cop like a massive drawdown, like a 55%, right? And so you can sell on this point when you break below on the monthly, and then you can buy back in, and you just added an extra pretty much 40% to your portfolio. So this is really like a bull market versus bear market indicator. Obviously, again, it's one that doesn't do very well in sideways market actions, but it is going to stop you from ever taking any huge hits. Like here, 22%, you got to avoid, right? This one probably actually would have taken a tiny loss on, but it's basically like, you're willing to sacrifice a few small losses over the course of the bull run to make sure that you don't cop a huge sell-off like this, for example, 47%, where you sit underwater for a year, for example. So yeah, these are pretty handy. So you can use it in with Confluence, right? So yeah, through here, right, we SFP the previous all-time high on a monthly time frame, and then we have the shooting star reversal, which is the key swing that we were talking about just before, right? And then you break underneath. So we're looking for, so when there's something like this happens, this is pretty much how the Bitcoin last all-time high just happened at 69K, right? So you have something like that happen. So we're looking for bearish triggers to hedge, get out, parts of our portfolio, something like that. And then it closes underneath this level. And then you go into the bear market from there, right? So pretty handy little tool for you guys to take a look at and check out. Okay, so let's moving averages. So we're going to go quickly into risk management here, and then that'll be it for today's session. Okay. All right, so risk management. So we've sort of talked about it a little bit already today, guys, but you have to sort of start to look at the market in terms of R, right? Risk to reward. So every time you take a trade, you want to be thinking about how much R you make in that trade, right? How much R you're going to lose. So if you lose 1 R per trade, that's 1% risk per trade. If you're losing 2 R per trade, because it's a very important setup, right? So sorry, I shouldn't say important. It's a really good setup that you have. You have the strike rate for that setup to, your entry to hit target is quite high. So for example, for me, my best setup is a falling wedge with a bullish divergence off a key level, right? That has quite a nice high strike rate for that to play out, right? So when I get those setups, I like to add a little bit extra risk. So I increase that risk from 1R to sometimes to 3R. See, sometimes people talking about taking 5R per trade. That's just ridiculous, right? Because, you take a couple of losses in a row on 5R, that's, you're going to end up taking a big chunk out of your portfolio quite quickly, right? So I like to keep it just to 1, right, for pretty much most trades. And this is going to massively help your trading psychology as well, because every trade is just 1% loss of your account, right? It's not like no trade is going to make you super rich. No trade is going to make you poor, right? You take 1% loss per trade. So it's more focused around trading the setup, right? Instead of trading your P&L, like, oh my God, if this is my stop loss, I'm going to lose, $1,000 or $2,000. Like, you're not stressing about that. You're not pulling your hair out. You're not staying up late at night being like, oh, I'm overexposed to risk, because if you get stopped out, you lose 1%, right? And then if we win that trade, we're going to lose. If we win that trade, we're going to win 3% of our account, right? And that will give us a risk to reward of 3-to-1. Okay. So what have I got written here? So we want to adjust our position size. So we take a stop loss, we lose 1R, 1% of our trading account. Okay, so here's an example of a Fibonacci setup, right? So basically price is coming back down. Let's move this off the side of the screen. right? Prices come, so we have the SFP down here, we'll come back up, and we're doing our 6.18, sorry, 0.618 to 0.66. So that's our golden zone or our Fibonacci's. And then we also have the daily order block through here acting as support as well. So daily key level plus our Fibonacci, right? And then we get the pin bar entry candle, potential for a reversal setup, right? So we're going to have our stop loss below this level here, which is 2.1% from the entry, right? And then our take profit is at the range highs, right? And this is also potential entry for inverse head and shoulders, by the way, right? And this is going to give us 6.1 R. So I'm going to make 6.1% of my account if this trade plays out and is profitable. I'm going to lose 1% of my account if I take the loss here. Okay. Okay, so we really need to shift the conversation in the community to be talking about how many R you made per trade instead of, you know, the percentage that you made on the trade. Because I think it's just a way better mindset to be in, and it moves you away from focusing your P&L to focus on the setup and how much risk to reward you're making, right? Okay, because you can have a 200% move on high leverage, doesn't really mean anything, right? You could have made 0.5 or just 1 R, right? And had a wide stop loss, so the position size was actually quite small. Or you could have a 15% move and you could have made 5 R on that. Right, understanding this sets you up to understand the risk to reward payoff matrix when you combine it with your strike rate to create your strategy. Okay, so in this example that we just looked at before, up here, right, our stop loss is 2.1% away from our entry. Our account size is $100,000 account. Our risk is 1. So what we need to do is we need to figure out what our position size is going to be when we take this trade, right? So we're 100K in our account. So we're going to put that first in the equation, which is total equity. So total equity times risk percentage divided by stop loss from entry is going to tell us the size of the trade that we need to enter. And this is going to mean when we take a loss on that trade, I'm going to lose 1 R, which means 1% of my account. Right, so I take this calculation, right, which is account size 100,000 times 0.01, which is our risk, which is 1 written in percentage, divided by 0.2021, which is stop loss 2.10% written as a decimal, right? So I'm going to copy that, and we're going to go here. We go to Google. And it's going to give us our answer. Okay, so all you have to do is write out this equation and type it into Google and it will tell us the answer, right? So 47,619 is the size that I need to put in when I enter into my trade. Leverage doesn't mean anything, okay? Yeah, the position risk calculator is great, but I do like people to get used to using the calculation so they know the calculation off by heart. If for some reason they can't find a calculator to do it for them, and just, you know, learning the maths as well, I think is important too. Right, so then we put that in, and yeah, basically what this means is if I lose this trade, I'm going to lose $1,000. If I win this trade, I'm going to make $6.1 thousand. Okay, and it ends up being a 6.1, right, trade. Okay, so let's go quickly have a look at the risk management, risk to reward payoff matrix. So this is a pretty handy little one that, yeah, basically every trader should know. And at the top, right, we have our strike rate. And then down the side, we have our risk to reward ratios, right? And so if your strike rate for your setup is only 20% and you have a 1-to-1, you're not going to be profitable. You can't even have a 2-to-1 and be profitable at 20%. You have to be above 4-to-1 R per trade to just break even. You have to be at a 5-to-1 to break even. So the setup that I'm running up here, right, the 6.1, if every single trade I take is 6 or higher, right, I'm going to be profitable on only just on 20%, right? On 30% strike rate, right, I can be sort of break even, just above break even, and be just in profit on 3 to 1. So 3 to 1 is really the main one that we want to be looking for, unless it's on a really high strike rate setup, like swing failure pattern, for example, when it's an actual swing failure pattern and not just a wick, right? And then the SFP to your first trouble area is, anywhere above 80 to 90% strike rate to hit that target, right? But it's not that hard to have an SFP that goes and hits. So what happens is the gap is quite small, but they're still worth trading, even though you have a lower R, right? Because we can see here, even at a 1-to-1, if you're above 50%, if you're above 60, you can take a 1-to-1 trade and be profitable, right? So hopefully this isn't too confusing and it's starting to add up a little bit. I do have the tool that Hazer made a long time ago, which is really handy. So Hazer basically remade his own version, which is a little bit sharper than the one that Travis Dobbing made. He originally taught the risk to reward section of our course. And this is an amazing tool. And then Hazer sort of reskinned this. So yeah, wanted to just say thanks to those guys for making this tool and allowing us to use it to teach you guys. And basically what we can do here is we can put in our strike rate at this point here. We can put in our risk to reward and it will tell us the percentage and it will give us a bit of a calculation here. So for you guys, this is a really good example of showing that you don't have to have a super high strike rate to have a profitable strategy. So once you do your back testing on your setups and everything like that, you can sort of think about it like this, and you can use this tool or a tool that's similar, and you can put the data in. It will give you an example, randomized information about how it works, and it will tell you if your strategy is going to be profitable or not, right? So if we have average risk to reward is 2, but our strike rate is 50%, right? It's going to be quite a decently profitable strategy over 1,000 trades, right? If our strike rate is lower, let's say it's 25%, but our average risk to reward, our R is still only 2, right? We're just going to lose money over the long term, right? So we have to have, if we have a low strike rate on our setup, which means we get stopped out a fair bit, we actually have to have quite a high risk to reward. Right? Even a 4 is sort of only just, break even, right? Just profitable, right? Even through here, right? So if we're running hours, which is 6, right? And it gives us a lot of wiggle room, right? But not all my trades are going to be 6 to 1. So generally we want to be looking for at least a 3 to 1, because if you start trying to have all of your trades like massive R returns, you're going to get stopped out a lot, right? And that's going to bring your strike rate down. And it's a lot easier to have a higher strike rate than on doing back testing than it is having live trading as well, right? So you sort of need to have a bit of understanding of how that works as well, right? So when you're live trading, your strike rate's probably going to actually be lower than when you're doing back testing. So it might mess up your data of your strategy, right? So 50% strike rate with average 3 to 1, and we're quite profitable over the long run, okay? So yeah, you don't have to be hitting like every single trade, right? And then if you do have like a 60% strike rate and you manage to have like a 3 to 1 or 4 to 1, you end up having a really nice trend in your equity curve. Okay, hopefully that makes sense. Now, this is a good little tool as well, and it's the consecutive losses matrix. This table basically shows the probability of consecutive losses based on your strike rate, right? So we have our percentage of strike rate down the side here, and then we have the probability of seeing at least 1, 3, 4, 5, 6, 10, 11 consecutive losses in a row over a 50 trade period. You can see how as our strike rate gets lower, right, we have potential for having much higher consecutive losers in a row. So once you do your back testing and then you do forward testing and you've been journaling for a while, you have your strike rate and stuff like that sort of mapped out, you can see even if you're just trading a 50% strike rate setup, there's potential that you have, there's a 50, I should say, let's go for 5, right? There's still a 76.8% chance, 50% strike rate, that you will have 5 losing trades in a row over a 50 trade period, right? So that means you have to have your risk to reward, right? If you're trading 1 risk or 2R or 5R, for example, right? And your trading strategy is only a 50% strike rate, you potentially could have a very high chance of losing 5 Rs in a row and losing a massive percentage of your account, right? Yeah, doing the course live is can be a little bit more helpful for sure. I always find I get more out of live than watching the replay of something for sure. So yeah, back to this. You have to have a good understanding of what your strike rate is and then be prepared, based on how you want to trade your risk to reward. So remember our calculation back up here, right? Risking one risk, even if I have, a pretty bad strike rate, like at 20%, right? I'm only 1 risk. I can have 10 trades. I can have 11 trades in a row, which is almost very highly likely at 20% in 50 trade period. I can go on a bad run of taking a whole heap of bad trades in a row. I'm only going to lose 11% of my account, right? If I'm trading at 20%, but I'm trading 5R every single trade, right? There's potential for massive blowout in my account. I lose 55, 60% of my account. So yeah, very important to understand this matrix table as well as this one, and then also understand the calculation, and then hopefully the tool showing the running balance and the different types of strike rates. If you guys want to, I can put in like a strike rate and then risk to reward, right? And we can see how it ends up playing out if you want to have a little play around. Right, so you can have a 90% strike rate, right, with a 1 risk to reward. It ends up being quite profitable, but that comes down pretty quickly. So the SFP strategy to first trouble area is about 80 to 90% depending on how good you are, and your risk to reward is usually 1 or under 1. It still gets a nice equity curve, right? Sometimes, underneath 1 risk to reward, you have to have a really high strike rate on that setup. Otherwise, it's not really worth it, right? Because as soon as you're under 50%, it's going to nuke your balance over time. This is Hayes's tool, so I might ask him if he wants to share it with the group, but I'll double check with him on that. Okay, let's keep moving. Okay, so yeah, I just basically gave the example here. Now we're going to go over stop loss placement and then wrap up. So there are basically 3 ways to set your stop, right? So you have 1 support away, 2 supports away, or the average true range, right? Your stop loss ultimately should be where the stop loss needs to be for that entry though, not placed to get you into a really small percentage away from your entry so that your R is huge, right? If you're having issues, you can use the average true range, right? And that sort of gives you, basically the average true range gives you the average range for that time frame, and it will give you a little number. So we can get that up in a second. I'll have to get that up on my chart. Okay, so to get ATR up, we can go like this. We can go down into our setup. Okay, so we have ATR through here. Let's go. Right, so this is our setup through here. Let's get rid of that moving average. Okay. So we've taken this Fibonacci from the low point right? And we track the impulse. So we'll wick low to wick high, and we track the impulsive move up. So now we're getting price coming back down into our little area zone of confluence to look for entries, right? And we're also looking for this to play as that head and shoulders reversal pattern as well, right? So we're looking for entries around this area. And remember that we just had a sweep of the range low, but that could also end up getting swept as well. So we need to take that into account. But at this point, when I trade this live, I was just looking to get into a position to play the inverse head and shoulders, right? So if we want to use average true range for our stop loss, right, we can get ATR up, which we just did. So go to indicators, you type in ATR, right, average true range. Okay, so we have ATR down here, and it's going to give us a reading depending on where our cursor is, right? So if it's over here, it's 195, 159, right? So back here, I'd actually come down a fair bit. So for the live chart, the average true range is 76.39. So to enter this position, right, we need to put our stop loss. So the entry would be at the close, and our stop loss needs to be, what was it, 76? Oops, 77.45, right? So then we go to the bottom of this candle, and we're going to measure down 77.5, right? And that's where the stop loss is going to be, a little bit below that, right? And then that will give us the setup that we want, right? And then we're going to be looking for the swing high point up here for our take profit, right? So the stop loss is a little bit lower, so it reduces our R, right? So we're not going to make as much, we're only going to make 5.27. Right? Okay, so that's for the average true range stop loss, right? And you can see I've done it here on the same levels. It reduces the R to 4.89, right? Because I think the target that I was looking at here is a little bit lower. So I put my stop loss below 79.6 away from entry. You can see the wider stop loss reduced my R. This means that I now have to be above 25% strike rate for this to be a profitable setup to take time after time. Okay, so this is a stop placement with the close entry, right? And this is just putting the stop loss below the wick with a little bit of a gap, right? I must have done something like that. I can't remember where I put the take profit, but we'll just leave it here. So that's 8.71. The example that I had pre-recorded, it's a 6.1 to that level up there, right? So with the higher 6.1, I can have a worse strike rate and still be profitable. Now, this is a second idea for our stop losses, right? We can do stop loss placement. So this should say far. So stop loss placement close is just below the wick, right? And stop loss placement far would be below the next point of support. So this was this point of support because we had the daily order block through here and the Fibonacci support as well, right? But putting our wick below there, you're seeing a little bit danger. You're probably going to get stopped out a lot more than if you put your stop loss down here and you're actually playing the higher time frame setup. So this is more like the entry you would take. The stop loss would be down here for like more of a daily type entry, right? So we've established that we're in sort of like accumulation range, and now we want to be getting in on this right shoulder of the inverse head and shoulders, which could lead to breakout of the neckline, taking position through this area here. Stop loss is going to be down here. And the other thing as well you can do is you can average in as the price comes down. As we go lower, you start to see one position here, two position here, three position here, and the stop losses be laddered as well underneath the local low through here also. That's a little bit more advanced, so you can sort of have a look at doing that as well if you're a little bit more an advanced player. Okay, but as you can see that this massively reduces my R. So if I'm looking to take the trade to here, it's going to be 1.55 R. Now let's have a look at it on a live chart. There's currently 8.7. I move the stop loss down to here. right? A little bit lower. Now we're at 1.54, right? If I'm putting that into our tool, right, I have to have quite a high strike rate if that's going to be my trades. Right? It's going to be have to be above 55 at least just to be profitable, decently profitable. And over 1,000 trades only make not that much money, right? So hopefully that sort of adds up and makes a little bit more sense. But if you were sort of trading this as the accumulation range, the higher time frame swing, you'd be looking for this to come up, maybe to this level here or like lower hanging fruit around here. And now we've got a 4.65 risk to reward. And that's probably a bit of a better trade for the higher time frame setup. Right, and that's going to be a bit of a better trade for the higher time frame setup. So maybe we're going to look for this cluster through here as the take profit area. Right, and we're getting 4.1. So that is a doable trade on the higher time frames and the higher risk to reward ratio, because if we're only trading for the 1.5, we have to be quite accurate just to be breaking even. So that is pretty much it for this session. Hopefully that makes sense. The main thing you really need to think about here for stop placement, though, the stop loss needs to be where your trade is invalidated. So at what point do you really need to say, my idea that price is going to do X is no longer reality? So for us, that this is going to be inverse head and shoulders, an accumulation zone, and breakout here and return to an uptrend. That is realistically invalidated after we break below this point here, right? But if we're just trading the 6.18 bounce, right? If price trades below the 6.18 for too long, and definitely below the 6.6, and the major level of support, which is this daily order block through here, if price trades below that, then that's going to be invalidated for that trade. So you can put them in both, and it will still fit the major requirement that the invalidation of our trade idea is going to be the ultimate place where the stop loss is put. Okay, so that's pretty much it for today, guys. Sorry we went a little bit over time. There was a lot to get through, and I probably yabbered on for a little bit too much at the start. Apologize for that. Hopefully you guys got a lot out of today's session. So the homework is to do one calculation for the position size calculation, which is this one here. And then go find a trade setup and map it out and use that trade setup. So I want to see the picture of your trade setup, right? Along with how much R you're looking to make on the trade, because we're focused on the R, we're not focused on the percentages. And then the invalidation, what the invalidation is going to be. I want to see the calculation, right? Which is, where is it? I want to see the risk calculation, right? So this calculation written out. Right? Pick whatever size trading account you want. You can do it on your own account, would be great. Or you can do it on a fake $100,000 account. You can do it on a pretend $10,000 account, whatever it is. If you don't want to share your position sizes, that's fine. But you can just use example 100K is a pretty good one. If that's unrealistic for you, use a 10,000. If it's small for you, use $1 million account, right? As long as it's relative. So yeah, give us the actual position, your actual setup, with your risk to reward ratio and the calculation put in place. You can have a play around with moving averages if you want to, but there's no real homework on that, to be honest. Maybe you can just do a little bit of homework on the daily 12-21 crossover and just look at the entries and exits on the 12-21 crossover over an entire market cycle. Do it on an altcoin, do it on a Bitcoin chart, and you can just add it up, do a little bit of back testing. So the entry, where the entry is, where the exit is. Okay, how much did you make off that swing? Okay, now we're taking a loss off this trade. How much do we lose off this trade? Doing order blocks, right? You can do it on the current cycle. So the key weekly levels, map out your key daily levels as well, right? So key daily swing points. You can do it on the current price range, or you can do it on the previous cycle price range. And then for the people who aren't so advanced yet, I would really like to see all you guys putting your higher highs and higher lows. Realistically, probably we should all do this because it's the basic #1 fundamental, right? So yeah, you can do this as well if you want to. Yeah, and then if you really want to, you can draw some trend lines in as well, and we will take a look at those. But the main ones I want to see is these market structure breaks, right? Because this is really the key setup. We spend a lot of time focused on these. So market structure break, right? This is key support and resistance flip. Short entry goes in here, right? This is a 3-to-1 R. These are the types of things I want to see you guys focusing on for your homework, okay? All right, guys. Cheers for the everyone listening to me talk for so long. A few Q&As. What's the best BTC chart to use? The index is a good one, right? Because the index has all of them. Right, so that's this one I have in blue. I'm usually charting on that. If you're not using the BTC index, Coinbase is a good one because a lot of market moves come from Coinbase spot, right? And then the one with the most volume is not Bitstamp, it is Binance. So I'm always having a BTC Coinbase chart. I'm always looking at BTC, that's Bitfinex, BTC spot Binance, and there's also a spot futures as well, because sometimes there's little bits of information that you don't get on some charts and you get on others. Right, so for example, let's jump on the high time frame. Binance, this wick low for the selling climax is much higher than if you look at the same picture on Coinbase, it's much lower, right? And that's because Binance froze on that sell-off dump because everybody was trying to short or whatever, right? And the exchange froze up. On Binance, back here at the low on the 4-hour time frame, there was a bullish divergence here, right? And same on some of the other charts as well. Pretty sure. Oh, it's really going to make him do it again. Right, bullish divergence here on Coinbase as well. If I can even find it. Sorry, it's XBT. I think this is this chart actually. There we go. On BitMEX, we go back to that same area. This is the old chart. This is what my chart used to look like back in the day. I haven't traded on this since, basically we broke out here because I switched from trading on around this area here. I switched from trading on BitMEX and became the non-main exchange. But I used to do all my trading on BitMEX because it was the market leader, and then obviously Binance, everything like that took over. So yeah, you can see how I have all those levels. Everything I've just been teaching you guys, all these levels were in the chart, right? And so anyway, if we look down here on BitMEX, we did not make a low. We did not make a new low here, and we did not put in the bullish divergence. So if you were just waiting here for bullish divergence for this to swing down, and Binance and BitMEX was the only chart you're looking at, you missed the bottom of the bottom entry of the entire cycle because you're only looking at one chart. So it's important to look at a couple of different charts, right? So that's why I look at the index chart. I look at Binance and Binance spot and Coinbase spot, and sometimes I'll also look at Binance perpetual as well because there's a lot of volume there. So that's pretty much it, guys. Hopefully that helped and you guys got some good info out of that. Are the gaps always defined as the space between the candle bodies? Yes. There's a couple of different types of gaps, and I will cover those later because there's a quite advanced topic. So you have volume imbalances and you have gap imbalances, and then you have gaps. So a gap is when there's a complete gap, right? I'll draw on the chart. Right, when your candles look like this. Right, and then we have wicks that go like that. Right, so imagine this is, right, let's make this a bit less, it's more obvious, right, and there's a gap. Right, so that's a gap, right, and there's a gap in between here. That's an entire gap, right? This is a volume imbalance because the gap, the gap is covered by the candle. So this is candle 1. Right, and this is candle 2. Right, and so this is a volume imbalance. So this is called a VIB, and that's because candle 1 closed here, but the wick covers the gap. Right, and then when the wick doesn't cover the gap like this, but the candle wick still can't speak, cross over, there's still a gap. This is a gap imbalance, and the gap imbalance would be this space here. Right, and they're blue on my chart. The VIBs, volume imbalance, which are these ones are a lot more common, they are yellow on my chart. Right, and then you have fair value gap, which is different as well. It's a 3 candle pattern. I'll show you what it looks like on the chart. Right, and so this is probably our most advanced trading strategy. And what we do here is we look for areas of confluence in the defining range that line up with our volume imbalances and our gap imbalances, right? This is an example of one entry here. We look for those to be areas of support and resistance. All right, and then if we go to our weekly time frame, we can see this gap imbalance from back here. Perfect tag for the bottom there. Okay, here's another example. Perfect tag for the other previous bottom was from that gap imbalance there, right? Come back down here, volume imbalance gets tagged. I'm not sure what that is. You can see they come down and get tagged a fair bit. So maybe this gap imbalance, volume imbalance here, we might come back down and tag that one before moving up again. We'll have to wait and see how that plays out. But yeah, this is like some much more advanced topic stuff. We'll go through that later on the course. Okay. Any other questions, guys, before we wrap up today? Excellent. Cheers, mate. No worries. All right. That is it. Sorry, went for a bit longer. I think it was a 2.5 hour session. It's probably a bit more realistic to be between 2 to 3 hours per session rather than just 1.5 to 2. But some of the sessions will be a little bit shorter depending on how fast we get through them. So yeah, I'm just going to turn off the recording now. If there's no more questions, anybody wants to answer quickly. Okay. You guys are watching the recording? We are off. Make sure you join the Discord. Make sure you register as well on the website. Thanks a lot for tuning in, guys. We'll see you all on Tuesday.